the Navayuga Engineering Company, building the future while setting new records in global engineering.
Thanks for tuning in to Bloomberg Quint. We are now truly into the earnings season, and the question on everybody's mind is whether this quarter will be or can be the quarter wherein corporate India manages to break out of the single-digit earnings growth. It's a point that's been raised once every 3 months for years now, hasn't fructified thus far. Is it going to be different this time around? Let's ask the Citi Research team that's put together a detailed report on the third quarter earnings expectations. Here in our studios with me and Darshan is Surendra Goyal, the head of India Research at Citi, and his colleagues Prashant Nair, Manish Shukla and Rashi Chopra. All of you, thank you so much for joining in. And really appreciate you doing this yet another quarter with us at Bloomberg Quint. Surendra, yet another quarter, more of the same? Or will this time around, we'll at least manage to meet the expectations that people have set out at the start of the quarter?
Yes, so first of all, thanks for having us here. See, from a quarter perspective, what we are expecting is that the OMCs, the oil marketing companies, will essentially pull down the reported earnings. Okay. So if you look at Nifty, ex-OMCs, we have a profit growth estimate of around 12% YOY. Again, which is also lower than what possibly was the expectation for the full year going into the year. But that's what is really pulling down numbers. If you exclude that, 12% is a decent number. But with that, it's practically no growth. So that's where we expect the outcome to be. I think what is happening in this, or what we expect to happen in this quarter, is that the top line growth will be pretty decent. So for the Nifty companies, we are expecting around 16-17% top line growth YOY. But there are, firstly, inventory losses in OMCs. That's what we expect. Secondly, autos, we expect some impact of discounting and what we saw last quarter. So margin pressures. Right. Similarly, commodities, metals, etc., we are expecting a pressure there. So when you put it all together, the overall growth still looks relatively muted, I would say.
Okay. So relatively muted bottom line growth for sure. What you pointed out the pain points. What about the larger themes, and how do you expect them to perform? Because I think a lot of what used to be consensus expectations have become anti-consensus expectations on a number of sectors. Some have moved from positive to negative, some have moved from negative to positive as well. What do you think will drive this set of numbers that will come in?
Yeah. So I think the biggest driver is financials, where we are expecting, among the Nifty names, we are expecting a 45% odd growth in financials, YOY. Now, and again, Manish is here, he can talk more about it, but one of the themes is, see, the retail banks were anyway doing well. The turnaround is starting to happen on the corporate side, and which is what is giving you this 45% growth. So that's, I think, the number which really stands out this quarter, or we expect to stand out this quarter. Because on the other side, like if you go beyond that, then staples, we expect a 14-15% growth, which is quite steady, I would say, but staples is normally very steady. Utilities is 10-12%, IT, what we had expected was 7-8%. So those sectors are anyway relatively more stable. So the outlier on the positive side, what we expect this quarter is essentially financials.
Surendra, the other thing is, your report, you said that you have an expectation of an earnings downgrade that would come in FY19 and FY20. The second quarter was not good at all. It was rather muted and all. Wouldn't that be priced in? The expectation anyway post the second quarter numbers would have been toned down. Yeah. So, and with 4 Nifty companies already coming out and them reporting rather muted numbers, no blockbuster, won't that be in the price already? Yeah. Won't people be expecting that this can be that?
So I think couple of questions there based on what you asked. So see, for last quarter, through the season and maybe a little after the season, we saw a 7% earnings downgrade. Yeah. Okay, so to that extent, yes, you are right, a big part got captured, but I think expectations were very elevated to begin with. Okay. Right? So like even after that downgrade, when I look at our bottom-up expectations, we have some 14-15% growth this year and 20% growth expectation next year. And some of the numbers I have seen on the street are even higher for next year. And to that extent, I think, yes, part of it has gotten priced in, but I think there is still room to go, because somehow the inherent assumption, maybe 6 months back, was corporate banks will really come back, which is happening. But then at that time, you really didn't expect that metals will be weak, there will be inventory losses, and autos will come under pressure, because that's not what the outcome was at, or outlook was at that time. So I would still think that there is some more room for the numbers to get downgraded.
Okay. Rashi, we'll talk about, he spoke about metal, he spoke about autos and metals as one pack. And I think the consensus view is that since how the commodity prices have moved and the spreads have actually squeezed for a lot of steel companies, are you expecting the numbers to be even worse than what the street is anticipating?
See, on India, the numbers in the next quarter should be worse than the numbers in this quarter. Because what we've seen is that the majority of the price cuts in steel in India came through in November and then December. And even right now, the domestic steel prices are at a premium to import parity. So my guess is we still see some more price cuts coming here. So the big chunk of the pressure effectively kicks in the Jan to March quarter. That said, I think the big surprise element could come from Tata Steel, the European business, because in their volume release, they've clearly highlighted that they've had operational issues, which is going to have an impact on the financial side. And I think that can sort of swing the estimates for the street quite a bit because it can have a significant impact on either side.
Interesting. What else would you watch out for? I think people have painted the year as to be a year of recovery for metals, but aside of Tata Steel, anything else in the metal space that you would particularly watch out for?
See, so, just taking a step back from what you said, we actually downgraded the steel space between November and December, first going to neutral and then going to a sell on all our stocks.
Okay.
So I think that's also a little bit of a non-consensus of sorts, where basically we think that the China property market is likely to see some decline in the starts, and that's going to have a follow-through effect into India. In any case, Indian steel prices are at a premium, and Indian valuations don't stack up particularly attractively versus the global peers. So, aside from the quarter, I would anyway keep watching out for the China trends. On the non-ferrous side, we've also seen like a fair bit of weakness across the commodity prices. What we need to watch out generally for is what's going on in, the recovery in the aluminium market, like the alumina refineries, etc., which have closed globally. And if we see some sort of an improvement based on, what happens in China over there. But effectively, I think at this point in time, there's really little to look forward to on a positive basis on the metal side. That's what we think.
So either earnings nor stocks, look at them too positively. Okay, you're contrary on another basket as well, which we will come to in a bit. But taking the conversation to what Surendra mentioned, the largest pack and what could happen there, what is your estimate? I mean, Surendra gave the headline numbers, Manish, but what's the thought of what will lead the performance and what could be the outliers that you may be contraried on in terms of earnings delivery in this quarter?
So this quarter, I think we need to separate financials as banks and non-banks, because non-banks will have their own pain points. But if you see at banks as a group, I think across the board we'll see good earnings because growth at the system level is coming back. There is some growth momentum. And because of a liquidity tightness, there is some pricing power with the lenders. NBFCs are largely out of the market, PSU banks are out. So the banks who have the ability to lend are able to price it well. The challenge is on the liability side. Across the board, if you see, deposit growth for the private sector is fairly muted. So I think growth coming back is a big theme. The other key variable in the quarter is the portfolio gains on the GSEC book.
Sure.
That will be fairly substantial, as well as write back of provisions will be large, because almost the entire first half loss has been reversed in 3Q. Right? Many of the larger banks might use that to cushion their NPA provision coverage, but nonetheless that can help boost your overall earnings. So I think banks as a pack should report pretty good numbers. Obviously, there will be some provisioning required towards ILFS related exposure, but that is specific to banks and not systemic in that sense. NBFCs, I think we will see moderation in growth as well as at least a 10 to 30 bips sequential margin contraction. Right? Now that is where the commentary is very important, because our interactions seem to suggest that as far as disbursements are concerned, December was more or less back to normal. But do they really taper down growth going into next year? Because many of the NBFCs, the way they were getting priced in earlier, we were factoring very strong earnings CAGR for many years to come. And this was a really large liquidity shock which came in, right? And we are in a seasonally tight environment for liquidity. February, March seems to be, always is very tight for liquidity, and hence RBI is doing a lot of OMOs to kind of preempt it. So I'm saying that's how you will relatively look at it. Corporate banks in general ought to do well because A, the growth is picking up, and B, provisioning sequentially should be lower. While still it might be a bit elevated compared to historical standards, but most of the NPA recognition is largely done. And even if you look at the RBI financial stability report, they themselves have brought down their NPA expectations for March 19 by almost 150-200 basis points. Right, so stress is lower, only some bit of provisioning needs to be done. Focus would be on growth, where is growth likely to come back? Does it come commensurate with margin and fees as well? I think operating profit growth related commentary will be very crucial for banks.
In the stocks that you've said that you are looking at as a positive commentary is ICICI Bank, and on the negative side it's Edelweiss. Can you give us the rationale why are you also positive and negative on Edelweiss?
No, so ICICI specifically because we believe there is NPA recoveries coming in, which will help them cushion their P&L, and growth momentum is picking up. For banks like ICICI and Axis, they have a favorable ALM in terms of a floating rate asset book and a reasonably large retail liabilities. So in a rising rate environment, your margin should kick in. Edel specifically, and I mean that would hold true for most of the NBFCs who have a decent wholesale book, that sequentially you will see growth moderation as well as margins under pressure. I mean what applies to Edel is true for most banks, most NBFCs who have a wholesale exposure and margins coming down.
Will it be bad for housing finance companies as a pack, because the entire issue that panned out, the NBFC crisis and the inventory levels, that was there in the second quarter but was not factored in. The results that came in did not factor all that. Sure. That is yet to come in this thing. Will it be really bad for HFCs this time? So
HFCs, it's interesting, right, that retail home loan sales momentum is really not picking up. Yeah. We are like in the same position for almost 3-4 months now. But the bigger HFCs who have had a long, strong parentage, I think they have been able to still raise money at cheaper prices relative to other HFCs. But wholesale across the board, as in be it construction finance or LRD, would see moderation, be it large HFCs or small HFCs. So you're in that sense right that earnings-wise it may not be great, but I think some of it is already there in stock prices. Question really is, will it be materially lower? And that will be a function of what is the outlook or guidance that HFCs come out and paint.
Okay, interesting. We'll talk about some specific pockets as well, but would want to get in Prashant into this conversation as well. I'm sure Darshan would have a lot more questions, but just an initial thought, Prashant. The headline number, Surinder indicated that you are contrarian on the space. What about the quarterly delivery of some of the companies?
Yeah, so it's very difficult to draw a common thread across all pharma companies because it's so bottom up depending on specific products. So as usual, I mean, we think this will be another quarter where trends will be quite mixed. Management commentary has been, cautiously optimistic over the last couple of quarters, and I think that will continue. Overall numbers should be okay because we are coming off a low base. Fiscal 18 was a very bad year. But specifically, we expect 2 or 3 companies, mainly Aurobindo Pharma, Apollo Hospitals, Cadila, to have good numbers this quarter, and the rest of the pack would be, I don't think there'll be too many surprises among the other companies.
I think the trend, another interesting trend that's been spotted is the hospital space. Obviously, Apollo seems to be doing extremely well, even if you see the stock prices thing, but the other hospital space aren't. So will Apollo continue to be a leader in this segment, and do you expect with the capex behind them that earnings growth over the next few quarters will keep on getting stronger and stronger for them?
Yeah, so it's largely a function of where you are in terms of your own capex and bed utilization. So Apollo has, is done with its big capex, and they've had investments in a few areas which, where they are seeding businesses. So all those investments are behind them, and we are beginning to see utilization improve. So that phase normally lasts for 3 to 4 years is what we have seen in the past. So we don't see why it should be any different. They still have enough capacity and they don't need to add fresh beds. So we think that that phase of margin expansion will continue, and probably this quarter we think it will be a positive surprise, primarily because usually the December quarter is a seasonally weak quarter, and that seasonal weakness will still be there, but because Apollo is coming off a base where there are significant losses in businesses like AHLL, which is their retail initiative, and those losses are coming off, that will help offset the seasonal weakness to some extent. So in that sense, we think QOQ numbers will look much stronger than they usually are. So I think that could surprise positively this quarter.
Okay. Interesting.
The other one is obviously Sun Pharma. What are you investing? What are you telling your clients to do on Sun Pharma? Because right now there are a lot of negative news that are coming in, which are not related to the financials, but the corporate governance issues of this thing. What are you telling them? And on the earnings recovery, do you see that happening anytime soon, till the time the specialty business kicks in?
Yeah, so earnings, our sense is, and while they don't split the specialty spends separately, but if you basically make some assumptions around that. The core business seems to be now fairly steady and maybe improving a bit. Halol is no longer a bottleneck for approvals. Price erosion has normalized, so the core business seems to be okay. Specialty spend will continue. We don't think that will ease off. So to that extent, numbers will be subdued to some extent. On the stock, it's a bit difficult to take a firm. We have a neutral rating at this point in time. We've had that for some time. You're right. I mean, some of the noise, particularly around the so-called whistleblower report, is difficult to analyze because there's not much clarity on what the contents are. So what we are essentially telling investors is, look, this is what the business is doing, and to that extent, post the correction, the business does not look very expensively valued. But there are these factors which we don't have much visibility on. Until you get more clarity there, it's very difficult to really take a firm call on how that could impact the rest of the business. Is it just noise, or could it be tangible enough to have an impact on how the business moves going forward?
Okay. Well, we'll talk about cement, we'll talk about some specific banking names as well, but Surendra, a couple of pockets with you. Firstly, a space that you track at the back of your hand, IT. Now, while the Wipro bonus announcement would have gotten that stock excited and TCS raising the guidance would have gotten that excited, the margin performance for the two majors that have come out thus far were not the best. What's the call here? Would there be margin pressure seen across the space? Incidentally, a mid-cap IT company that came out with numbers also wasn't the best performance. Would there be margin pressures across the space? Which are the names that you would watch out for the most?
So I think, see, margin pressures have been there for many years now. Okay, so I don't think really anything has changed. I remember in our sector downgrade in 2014, which is way back, one of our key arguments was the sector will not grow as profitably, or profitable growth will be more difficult to achieve than what investors are expecting. And that has not changed. So if you see, there are a few things going on at the same time. Firstly, there is a big part of the business which is the legacy or the traditional business. There is always pricing pressure on that. And then the new business, which is the digital business, as companies call it, that requires a lot of investment, right? And when you put it all together, then it essentially becomes a currency call. The year we get a 8-10% rupee depreciation, things look okay, which is what last year was. If you don't get that, then you will start feeling the margin pressures again. So when we wrote our outlook this year, early January, we actually said that we expect margin pressures to become tougher, worse. Because in addition to the medium-term headwinds that I spoke about, there are two things which one needs to keep in mind. Firstly, the US visa situation is not easy. Okay, like when you talk to companies and talk to sector participants, renewals is a challenge. Okay, costs of doing business in the US are going up. One of the large companies actually in their commentary said that cost increases in some of our key cost of doing business in some of our key markets. So that is already happening. Secondly, on the India part of the supply, what happened is these companies, most of them were very focused on improving utilization for a 4 or 5 year period. And suddenly what we have seen is in the last 6-9 months, these companies have all started to hire. And when all of them do it at the same time, it creates supply pressure here also. So which is where we think, and our house view for this year is a broadly stable rupee. With a stable rupee, I think you will continue to see margin pressures. If you get a 7, 8, 10% rupee depreciation like you had last year, then some of that can be hidden. The other way to look at it is even last year, look at any company, just do a YOY comparison, and you will see that the gross margins have gone up only a little bit, if at all, despite a 10% rupee depreciation, right? Which kind of tells you that the pressures on the business from a margin perspective are still very much there.
Okay, so in which case, what would you believe would happen to these companies in terms of the earnings delivery and going ahead? I mean, Infosys has kind of raised the guidance a bit. Are you optimistic on that vis-a-vis TCS, vis-a-vis HCL Tech and others? Yeah. And broadly, if you have some mid-cap IT companies within your coverage, because a lot of disappointments are coming through. Persistent promising for a long time, finally the street seems to be giving way. Mindtree, there could be some reshuffle on the promoter side. Any thoughts here? Yeah.
See, firstly, from a sector perspective, our earnings are generally 5 to 15% below consensus.
Okay.
Okay, so that even in stocks where we have a positive view, we might be actually slightly below consensus. And that too is, as of now, we are still assuming 71.5 on the currency. Okay, so that's something to watch out for, because if you actually get 70, then our numbers could actually get revised lower. Now, within that framework, Infosys was a top pick going into the year. In fact, we had upgraded it some time back, and it was a top pick primarily because what we expected is they are, over the last year or so, they have really been investing in the business. Okay, the deal flows were all visible. Last 2 quarters were very strong on deal flows, and we were expecting a revenue acceleration. And the starting point on valuations was quite comfortable. Like Infosys at parity to the market, it's a bellwether stock at parity to the market, 25-30% discount to TCS was a good starting point. Okay, so while our sector outlook, what we mentioned is sector, we remain cautious. Okay, we are worried about the sector, but within that construct, Infosys looks like the best idea. So which is why we are still positive on it, and what they delivered on the revenue side, it was a beat and raise, right? Margins, they have pressures, but I still think that in FY20, margins, they may be relatively better than others because they have been investing a lot. And as some of those investments start yielding results and normalize, you could actually see them do better compared to others on margins. And which is why relatively we are most comfortable with Infosys at this point of time on the large cap space. Mid caps, I think the kind of situation we are in where the rupee support may be less, at least that's what our view is. And you have supply side pressures both from India and the visa situation, generally a tough place to be in. Okay, and you would have seen last year some of these mid caps had a great year, right? Because the leverage works both ways. Last year they benefited more. Stocks were like at really low valuation start of the year. Like L&T Infotech, which is a top mid cap pick, did what, maybe 80% or some number like that last year, huge returns. Now going forward, our view is one has to be selective. Near-term returns could be muted. But the only mid-cap in my coverage, which I am still kind of saying that, yeah, this is a good story medium term, and we continue to like it, is L&T Infotech. Okay, so other names, again, you have like, so Persistent, we have been generally negative for the last 2-3 years. Our concern has been, despite the company kind of making that initial move into digital, they have never been able to benefit out of it too much. And there have been margin pressures. Right, Mindtree, we liked it for a bit, and then we kind of downgraded, but there, of course, the other part which you mentioned in terms of the change, even on the business, there is a lot of growth which comes from shorter cycle projects, right? And that's a part of the market whenever you are concerned about the global macro, you start getting concerned about short cycle consulting kind of projects, and where Mindtree's dependence in our mind is possibly higher than some of the larger companies. So which is why Mindtree, we have a neutral for now, Persistent, we have a sell, but we are very selective in the mid-cap space.
Okay, I was very surprised to see that you all have a little contra view as far as cement is concerned, because across the brokerages, if you read, most of them have written cement off because the main reason they say is pricing power is not there. What's your expectation, and why is Ambuja something that you all like?
So on the quarter, not so much to expect, even on cement actually. So we saw a really good 1Q, then we saw a disappointing 2Q. And what's happening in this quarter, so it appears that the industry demand growth is somewhere between 7 to 8%. Okay. Pricing should be more or less flattish to slightly lower. What we figured is that prices improved in the northern India, prices fell in southern India, and was largely range bound in the rest of the regions. What we were looking forward to is cost benefits kicking through with the, with the fall in crude petcoke prices, but most of the cost benefits should come through again in the fourth quarter. So from a quarterly result perspective, we don't really, we expect a slight decline in the EBITDA per ton actually, except maybe for Ambuja, which had gotten hit quite badly in the last quarter on their other costs, maintenance costs, etc. But the contrarian view really comes from the fact that, we're of the view that cement demand growth is likely to outpace supply growth. I mean, there can be a lot of concerns, there's elections, we don't really know what's going to happen, but effectively whatever government comes in place, we will see a constant focus, on this whole housing sector, the rural sector. We've seen this whole kickoff coming through in the Prime Minister's Awas Yojana program, etc. So I do believe that, that demand growth should continue. And while difficult to really say what that actual growth number would be, our view is that supply growth is likely to be somewhere around 4% per annum. So demand should most likely outpace that. And in an improving utilization environment, prices should start moving up. Again, one can argue that, demand has been strong and we haven't seen that price increase coming through. One of the reasons was that we were dealing with distressed M&A, that there was some capacity which was operating at low utilization levels, and after having been acquired by the larger players, we've seen the utilization levels move up and therefore more supply come in. And I don't really think we have a lot more distress M&A that's left, which would come and spoil the pricing environment, so to speak. So therefore, I think that pricing should kind of improve as utilization levels improve. Second thing is that on the cost side, like I mentioned, like the next quarter probably costs could go down by about 100 to 150 rupees just purely on diesel or on pet coke. So we actually like the sector. Even on, one can again, there's a lot of questions on valuations, etc. And to your question on Ambuja, ACC and Ambuja are two stocks which trade at around replacement cost at the moment, right? So if we get a price hike in cement, I actually think the upside could be more for these stocks than the others, simply because the market hasn't really appreciated the fact that there hasn't been any growth in these companies in the last many years, whether it's capacity growth or volume growth. But in the last year or so, what we've noticed is that this, the group, the Lafarge Holcim group, has focused on volume growth. They have focused on costs, and very recently they have announced growth capex, capacity additions in both the companies. So it kind of shows that there's a limited reason for why that discount should be, so wide, and therefore that should start narrowing down. Okay. On the flip side, if we were in a scenario where we don't see price increases, if that scenario were to play out, given where valuations for these companies are, one is they are at replacement costs. Second, even on consensus estimates, they are both trading at about 1 standard deviation below mean on EV EBITDA as well. So the downside is kind of protected on both these stocks.
Let me step in here. I think the easiest way to see this is last year, everything that could have gone wrong went wrong. Okay. Be it pricing, be it raw materials which went up, and valuations corrected. Okay. And right now, when you obviously talk to investors, everybody is very negative, as you rightly said, right? But we see a lot of comfort from a downside perspective, given that a lot of negatives got priced in and valuations are where they are. And at least when I wear my strategy hat, like 1 year back or 1.5 years back, when we were asking people to buy Apollo hospitals, for example, we used to get similar pushback because at that time things were really going against them. We think that valuation support is there. You see a little bit of a fundamental improvement, and given the ownership expectations, etc., this sector could be one of the better performers this year.
Okay, that's very much. We're just about out of time, but Manish, just quickly, a minute answer. We dwelled into what you want or what you believe ICICI Bank, etc. could do. Just one quick minute on the corporate-facing large PSU banks. What do you expect this quarter? Are you bullish on the SBIs, BOBs of the world?
No, so large PSU banks, again, in fact, if you've seen, their NPA recognition was ahead of private banks. So they are in a situation where they are likely to see recoveries. But because PSU banks, as of last quarter, were carrying very high liquidity because their LDRs are low, their gains on treasury book are going to be very large. I think that will really skew the financials for the quarter in a big way. But I am sure that NPA recoveries for corporate PSU banks would be at par or better than what you would see for an ICICI or Axis, because they were earlier in the cycle in recognition, right? And incrementally recognition is lower and lower. So to that extent, in case of Bank of Baroda, no matter what the quarter says, questions will be around the merger, right? So that is a big event that people are talking about. How does that play out, etc.
Okay, we'll watch out for all of these. Rashi, gentlemen, thank you so much for taking the time out and being with us today on this broadcast. And from Darshan and me and the team that put this show together, thanks so much for watching.